Everyone is betting on the AI boom by buying Nvidia. But every single Nvidia chip, and every Apple chip, every AMD chip, every Google AI chip, first has to pass through the factories of one company most investors never talk about. It's the closest thing the global economy has to a monopoly. And it sits about 100 miles from China. The company is TSMC, Taiwan Semiconductor. It doesn't design chips. It doesn't sell phones. It has no consumer brand. It just manufactures the most advanced semiconductors on the planet for almost everyone. When people argue about who wins the AI race, they name Nvidia, OpenAI, Google. But there's a layer underneath all of them, the actual factory floor, and TSMC owns it. So tonight, I'll show you why TSMC may be the most underappreciated way to own the entire AI boom at once, the pricing power that gives it margins no other chipmaker can touch, and the single risk that could undo all of it overnight. Start with one fact that reframes everything. TSMC manufactures roughly 70% of the world's foundry chips, and when you narrow it to the leading-edge chips that AI actually runs on, its share is close to total. Every Nvidia GPU, every Apple processor, every AMD AI accelerator, every custom chip from Google, Amazon, and Microsoft, they are all designed by different companies that compete viciously with each other, and then they all line up at the same factory. Think about what that means. You don't have to guess which AI chip company wins because they all route through TSMC. It is the toll booth on the entire highway. So here's the question to sit with before we go further. If you could own the one company that gets paid, no matter which AI chip wins, what would that be worth to you? Now, here's how that dominance shows up in the numbers, because this is the part that's genuinely rare. Most semiconductor companies run gross margins around 30 to 40%. Intel's been near 32%. TSMC just guided gross margins in the mid-60s. That is software-like profitability from a company that runs physical factories, and it comes from one place. There is no real alternative. Its newest 2-nanometer process went into high-volume production at the end of 2025, and TSMC is reportedly charging around $30,000 per 2-nanometer wafer, roughly double what the previous generation cost at launch. Customers pay it, because the only other option, Samsung, is stuck at lower yields and a fraction of the market, and China's foundries are locked out of the leading edge entirely by export controls. When you're the only one who can make the thing the whole world needs, you set the price. That's why TSMC just raised its full year 2026 revenue guidance to grow more than 30%. If you followed this channel, this is the layer beneath everything we've covered. We did AMD trying to rewrite the memory stack. We did Micron and SanDisk fighting over the memory itself. But all of those chips, the logic, the accelerators, are physically etched by TSMC. Even the AI memory boom needs TSMC's advanced packaging to bolt that memory next to the GPU. That packaging, called CoWoS, is booked solid, and TSMC is expanding it at roughly 80% compound growth a year and still can't keep up. Nvidia alone takes about half of it. So instead of picking the winning chip, TSMC lets you own the bottleneck every chip depends on. That's the bull case in one line. It's the most diversified single stock bet on AI you can make. And that is exactly why the risk on the other side is so important. Here's what the bulls wave away, and you shouldn't. TSMC's most advanced factories are in Taiwan, an island that China claims as its own territory and has never ruled out taking by force. That is not a stock risk you can model on a spreadsheet. If the worst case ever happened, it wouldn't just dent TSMC's earnings, it would freeze the entire global technology economy, because there is no backup factory for the world's advanced chips. That concentration is the same thing that makes TSMC powerful and makes it fragile. TSMC knows this, which is why it's pouring a potential several $100 billion into new fabs in Arizona, one already producing, more under construction, to build a supply line outside Taiwan. But that's a years-long project. The most advanced nodes still come from Taiwan first, and it's partly driven by the threat of US tariffs on chips made offshore. So you're buying the most dominant company in tech, sitting on the single most dangerous fault line in geopolitics. Both of those are true at the same time. Let's be honest about the whole picture. On fundamentals, TSMC is close to a perfect business, a near monopoly on the most important product in the world, margins most software companies would envy, and demand it literally cannot fill. And it carries a tail risk most companies will never face. Its growth is now tied to a capital spending cycle that won't boom forever. And a lot of good news is already in a stock that's run with the whole AI trade. The mistake is treating it as either a sure thing or a landmine. It's both. The real question was never whether TSMC is a great company. It obviously is, maybe the most important one on Earth. The question is whether you're being paid enough today to hold a great company that comes with a risk no balance sheet can erase. So here's the debate I want you in on. The bulls say TSMC is the single best way to own the entire AI boom. You collect the toll no matter which chip wins. The bears say no margin and no monopoly is worth it if the factory sits on the world's most dangerous fault line. Where do you land? Is the geopolitical risk a deal breaker, or the reason it's still underpriced? Tell me in the comments, because I read them. And if this showed you the layer of the AI boom nobody talks about, subscribe. This channel breaks down one company at a time, no hype, no noise. I'll see you in the next one.